Hey there! Do you want to make your money work for you instead of just sitting in a savings account? Today, we're exploring one of the best tools for building wealth, the stock market. Don't worry if you're a complete beginner. I'll guide you step by step in the simplest way possible. By the end of this video, you'll know how to start your investing journey. Let's jump in. Imagine the stock market as a giant pool party for companies. It's a vibrant, dynamic place where businesses of all sizes come together to share their potential with the world. Just like at a pool party, there's a lot of excitement and energy, and everyone is looking to make a splash. Instead of swimming, companies offer pieces of themselves, called stocks. These stocks are like tickets to join in on the fun and success of the company. When you buy a stock, you're not just a spectator, you're a participant in the company's journey. When you buy stock, you buy a small piece of that company. This means you have a stake in its future. If the company does well, so do you. It's a way to be part of something bigger than yourself, to share in the triumphs and challenges of the business world. It's like getting a slice of all their hard work and future success. Imagine being able to say you own a part of a company that's changing the world. It's an exhilarating feeling, knowing that your investment is helping to drive innovation and growth. Think of it like owning a piece of your favorite bakery. Every time they bake a delicious cake or cookie, you're benefiting from their success. It's a sweet deal, literally and figuratively. As the bakery sells more cookies and cakes, your piece becomes more valuable. The more successful the bakery, the more your investment grows. It's a simple yet powerful concept that applies to all kinds of businesses in the stock market. You're not just watching from the sidelines, you're a part owner sharing in their profits. This means you have a vested interest in the company's success, and you can take pride in being part of their journey. The stock market is where these shares are bought and sold, kind of like a bustling marketplace. It's a place where buyers and sellers come together to trade stocks, each with their own goals and strategies. The energy is palpable, and the opportunities are endless. Just like any market, prices go up and down based on how well companies are doing and what buyers are willing to pay. Don't be intimidated. The fluctuations are a normal part of the process, reflecting the ever-changing landscape of the business world. You don't need to be a Wall Street whiz to participate. With the right knowledge and tools, anyone can get involved in the stock market. It's about making informed decisions and understanding the basics of how the market works. With a little knowledge and guidance, you can jump into the stock market pool and start growing your wealth. It's an exciting journey, full of potential and opportunities. So why not take the plunge and see where it can take you? Owning a slice. You can own a company. When you buy stock in a company, you become a shareholder. This means you own a tiny piece of that company. Let's say you buy stock in a company that makes your favorite shoes. As more people buy those shoes, the company makes more money, and your piece of the pie grows larger. You're not just betting on a company's success, you're investing in it. Your money helps them grow and innovate, which can benefit everyone. It's like planting a seed that has the potential to grow into a mighty tree, providing shade and fruit for years to come. Remember, owning stock isn't about getting rich quick. It's about participating in the long-term growth of companies you believe in. It's about taking ownership of your financial future and building wealth over time. Money-making money, the magic of compounding. This concept is often referred to as the eighth wonder of the world by financial experts. It's a simple yet incredibly powerful idea that can transform your financial future. One of the most powerful concepts in investing is compounding. It's the process where the value of an investment increases because the earnings on an investment, both capital gains and interest, earn interest as time passes. Compounding is like earning interest on your interest. Imagine you have a savings account that earns interest. At the end of the year, the interest you earned is added to your principal, and the next year, you earn interest on the new, larger amount. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow, getting bigger and bigger. This is a perfect analogy for compounding. As it rolls, it picks up more snow, getting bigger and bigger. That's compounding. The snowball effect illustrates how small amounts of money can grow into large sums over time. When you reinvest your earnings, those earnings start earning their own earnings. This cycle continues, and over time, the growth can be exponential. It's a snowball effect that can lead to significant growth over time. The longer you let your investments compound, the more powerful the effect becomes. Let's say you invest $100 and it earns 10% interest. The first year, you earn $10, so you have $110. The next year you have $110. But here's where the magic happens. You earn 10% on that $110, not just the original $100. So the second year, you earn $11, bringing your total to $121. This process continues, and over time, the amount of interest you earn each year grows larger and larger. The earlier you start investing, the more time your money has to compound. Time is a crucial factor in the compounding process. The longer your money is invested, the more it can grow. It's like planting a tree. The sooner you plant it, the bigger it will grow. Just like a tree needs time to grow and flourish, your investments need time to benefit from compounding. Don't underestimate the power of compounding. Even small amounts of money, when invested wisely and left to grow over time, can result in substantial wealth. It's the key to unlocking exponential growth in your investments. By understanding and harnessing the power of compounding, you can set yourself on the path to financial success. Section 4. Your first steps on Wall Street, getting started. Welcome to the exciting world of investing. Whether you're a complete novice or someone with a bit of experience, this guide will help you take your first steps towards financial independence. You don't need a fancy suit or a Wall Street address to start investing. In fact, you can begin your journey right from the comfort of your home. All you need is a computer or a smartphone and an internet connection. Here's how to dip your toes into the stock market. It's a process that might seem daunting at first, but with the right guidance, you'll find it quite manageable. First, open a brokerage account. This is your first step towards becoming an investor. A brokerage account is an essential tool that allows you to buy and sell stocks, bonds, and other securities. Think of a brokerage account as your gateway to the stock market. It's like having a key that opens the door to a world of investment opportunities. It's where you'll buy and sell stocks. The process is straightforward. You place an order to buy or sell, and the brokerage executes it on your behalf. Many online platforms make it easy and affordable to open an account. These platforms often provide user-friendly interfaces and a wealth of educational resources to help you get started. Next, learn the ropes. Before you start buying stocks, take some time to learn the basics. Understand different investment options such as stocks, bonds, mutual funds, and ETFs. Each of these has its own set of characteristics, risks, and benefits, like mutual funds and ETFs, which are collections of stocks or bonds that you can buy as a single unit. These can be a great way to diversify your investments and reduce risk, which allow you to invest in a basket of stocks. This means you don't have to pick individual stocks, which can be risky and time-consuming. And lastly, start small and grow. It's important to begin with an amount you're comfortable with. Investing doesn't require a large sum of money up front. You don't need a fortune to begin investing. Even small, regular investments can grow significantly over time thanks to the power of compound interest. Start with a small amount you're comfortable with. This could be as little as $50 or $100. The key is to get started and build the habit of investing, and gradually increase your investments over time. As you become more comfortable and knowledgeable, you can increase the amount you invest. Remember, investing is a marathon, not a sprint. Be patient, stay informed, and keep a long-term perspective. The stock market will have its ups and downs, but over time it has historically provided solid returns. And don't be afraid to ask for help along the way. There are many resources available, from online tutorials to financial advisors who can provide valuable guidance and support. Happy investing. Section 5. Talking the talk stock market lingo. Let's decode some common stock market terms. First, bull market. A bull market is like a party where everyone's buying stocks and prices are rising. Think of a bull charging forward with its horns up. Next, bear market. A bear market is the opposite. It's when stock prices are falling and investors are feeling gloomy. Picture a bear hibernating during the winter. Then, dividends. Some companies share their profits with shareholders through dividends. It's like getting a bonus check for owning their stock. And finally, market cap, or market capitalization is the total value of a company's outstanding shares. It's like measuring the size of the company in dollars. Understanding these terms will help you navigate the stock market with confidence and make informed investment decisions. Section 6. Steer clear common investment pitfalls. Even seasoned investors make mistakes. Here are some common ones to avoid. First, investing without research. Don't buy a stock just because everyone else is. Do your homework. Understand the company, its financials, and its future prospects. Next, trying to time the market. Trying to predict when the market will go up or down is like trying to predict the weather. Instead of timing the market, focus on time in the market. And lastly, ignoring diversification. Don't put all your eggs in one basket. Diversify your investments across different companies, industries, and asset classes to reduce risk. Investing involves risks, but by avoiding these common pitfalls, you can increase your chances of success.